Recording in progress.
Are we good?
Yeah.
Well, hello and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. And thank you for joining us for today's 2023 first quarter update, market outlook, as well as our insights as to what's to come. And sort of a general overview for our clients and friends and family that are following along. And also, if there's any part they need to jump off, we're going to have a recording for you so we can send this to you and we'll have the link. So don't feel as if there's something in the, today's presentation where it's something you want to review or you want to see a slide again, or even want to talk to us again, just come on by and we'll happy to discuss it with you in more in depth and anything that piques your interest. Let me do this. Let me go to the next slide. And real quick. All right, well, let's just continue. The questions during this call today, we're going to talk about the markets, the Federal Reserve, earnings, Congress, and the health of the U.S. consumer, and what's happening. Number two, we're going to talk about what happened with the banks this last quarter, as well as sectors that we find attractive moving forward in portfolio positioning, as well as historical review of basically asset allocation and the power of diversification. It's what we definitely subscribe to and employ for our clients here at Blanke Schein Wealth Management, as well as will the U.S. enter recession? Are we there yet? And it's key. I mean, this has been one of the most sort of biggest topics that we've been talking about for a good 6 to 12 months, and remains to be seen. So we'll discuss that. And what should investors be watching for the next 6 months? What's new? If you're following along at home, and we appreciate that you are, we moved to a new office back in December. So we have a new office in El Paseo. So we've got an El Paseo storefront. You can walk by and say hello anytime you're in the Palm Desert area, as well as we have great parking, handicap parking, and everything in the back. So we've got 2 entrances, and if you haven't stopped by, please join us. This is a photo of our ribbon cutting with the Palm Desert Chamber of Commerce and one of our great clients there, who's one of the wonderful ambassadors for the chamber. She just was recently honored. So she's a wonderful fixture within the and leader within the Palm Desert community. So we thank her very much for coordinating this. But that was a wonderful day where we had ribbon cutting, as well as I was recognized, and Blanke Schein Wealth Management was recognized once again for Forbes Best in State. And that was pretty fun recognition. What's significant about that is that the year end in the fourth quarter, there is a conference with all of the great market heads of state, if you will, and we get some great insight there. So it's a wonderful thing to attend. If you're at home, and you haven't subscribed to our YouTube channel or even our Thursdays market insights and observations, many of you have. Again, it's free, it's easy to do. You can share with friends and family, and you can follow along anywhere wherever you happen to be. This is a kind of a fun. Many of you have acknowledged the fact that like you follow along, whether it's Fox Business, Bloomberg, Street Signs, or even CNBC. One of our clients shared this with us. He was actually on a cruise in Portugal, and my media hit was, I don't know if you know, but sometimes they're 2:30 in the morning Pacific Standard Time. So I'm here in this studio at 2:30 in the morning Pacific Time. But he was around the world, and this is his cruise ship. And he says, Rob, I'm following along. So that's kind of fun. And thanks for sharing that. The HighTower story, if you're new to HighTower or you're curious about HighTower, we're accredited investment fiduciaries, and we have over 105 advisory teams. Our national office and our home office is in Chicago. And we have well over 33 states and growing substantially, which is fantastic. Our strength and leadership continues to grow. Another great thing is our commitment. Again, I said we are accredited investment fiduciary, so there's nothing for us to sell. We have access on an institutional level of all that Schwab and Fidelity have to offer. So ultimately, we're definitely financial planning driven. And then we create a solution for you and our clients that's basically on your current situation in life, your goals and your feelings. We take a long-term approach, and that's sort of the theme here as well that we're going to discuss as well. Is it's always great to take a long-term historical perspective, especially how we invest and move forward. This is our disclaimer. This will make all of our attorneys at HighTower extremely happy. Take time and pause it at home if you want to read it. But one of the advantages that we have working with HighTower, again, we have access to institutional as well as investment resources and research access that is, we believe, second to none, and also the institutional level. So some of the partners that you see here, we get in our morning email, bright and early, probably 3 to 4 o'clock in the morning, our time, and our team, our investment committee here, Blanke Schein Wealth Management, we dig through it, and we have access to this, and that actually helps us with deriving our asset allocation and our portfolios and our investment management philosophies. Again, I talked about sort of our custodials that we work with Fidelity and Schwab, as well as some of the acknowledgments and the awards that we've seen through the years. This is the 5-step burning questions about retirement, five-step comprehensive wealth management experience that we have for our clients. And right in the middle, everyone looks at us and says, you're a wealth advisor, you're a financial advisor. Right in the middle, it's all about the investments, whether it's a retirement account, your 401k, stocks, bonds, and your personal finance. But what's really important is everyone comes to Blanke Schein Wealth Management because they want, to the left and the right. They want the income. If you're not retired, and you want that income to continue all the years and beyond and stay ahead of inflation. And that's what we do in our planning for you. And also maintain that lifestyle, that worry-free retirement. I want to travel, as we showed you, as clients do around the world. But we also want to pay for education for the grandkids, and we maybe start a new career in retirement as well. Well, that's all great, but if you don't take care of the outer sort of boundaries here, one is legacy planning. So making certain the estate plan. Have you visited your estate planning attorney recently? When is the last will update in your trust? Has that been reviewed? If you need recommendations, we're happy to give you recommendations. But that's more important almost than the investments right in the middle, because that could derail a plan. As the same side, on the other side, the healthcare, or do you have long-term care insurance? Are you providing or putting a portion of your portfolio that's basically positioned for healthcare long into the future? And then do you also have the advanced medical directive? Again, that's under the estate planning arm. But those are all things that really, while you come to us as the investment advisor, we're also the wealth manager. We look at the holistic approach, and those are keys to making certain that your retirement's well looked after. We also have the True Retirement 360 dashboard. It's basically the 3 documents that we provide every client, especially if you're a new client. We start you off with this. It's your financial plan. Again, it's your income statement annually, it's your net worth statement, and it's basically your retirement income intelligence. And that's a proprietary process that we have. And that's a document that we provide here's your current situation. Are we on the same page financially speaking? If things are changing, there's a medical situation in the family, we have to care for that person. What pocket do we take it out of, and how do we fund that? Will really impact whether it's the taxation or anything else, and so on and so forth. Or I want to take a trip around the world. Rob and team, what's the best way to do that? So let's just dive right into the first quarter. If I were to say that we had a banking crisis, a real-time digital banking crisis in the first quarter of 2023, but yet the S&P 500 was up 7%, and even the NASDAQ was up 16.8%, would you have been in the same camp as me if you were to hear that and then say, wait a minute? And we'll go through all the reasons why that's the case. I think one of the reasons is markets were overdone on the downside last year, especially in the last year in October, November to close the year, as well as the swift action of the Federal Reserve and the Treasury to help the banking system secure it and be absolutely proactive, as they weren't in 2008. But this isn't a 2008, but we'll talk about that. And then again, the diversification, the broad diversification is what we have in client portfolios. So even if you see the S&P 500 up 7% for the first quarter of this year, and portfolios have performed better than that for our clients in most cases, you also see under the hood. So there's 11 sectors of the S&P 500, from information technology, consumer services, discretionary, materials, industrials, real estate, consumer staples, utilities, healthcare, energy, and financials. So while financials, again, were down for the first quarter of this year, you still have information technology that was up. So you blend them together, and that diversification keeps you in the game, if you will, in terms of it's limiting the volatility, but you're not exposed to just one sector. And oftentimes when we see new clients, they're overweight sector, and they wonder why they're underperforming from time to time relative to the benchmark or even their peers. So what happened in the first quarter of the banks? Well, in the United States, the banking system has a fractional reserve banking system, which means they have your money on deposit and about $22.9 trillion in assets and about $20 trillion in liabilities. And against that, the banks basically lend off of that. We've all seen Jimmy Stewart, It's a Wonderful Life. And that's essentially what he has is, your money is here and it's safe and secure, but it's also being used. And banks make money when they start lending. And so we saw that seize up this first quarter simply because some banks were overextended and they made some significantly bad investments because the interest rates because the Federal Reserve rose interest rates so quickly that they basically got caught off sides. And so their portfolios were negative cash flowing. And then one thing led to another, one bank after another. Some banks needed to be bailed out. And that's exactly what the Federal Reserve did. Now, the large banks, the money center banks, again, went through this in 2008. And since reforms have been put in place, as well as cash reserves and higher capital ratio limits are put in place for the big banks. But the small regional banks sort of flew under the radar. And again, I'm going to skip through here, but essentially it's banking 101. And that's what happened with the banks here. But the reality of the situation, the banking system in the United States is healthy, it's secure, it's well capitalized, again, since 2008. So we're not going to have something like that play out. Again, as I said before, it's also the swift movement of the U.S. Treasury and all of the powers that be, which was, they should be applauded for working so quickly so that they contained sort of a one-off, two-off situations. That doesn't mean that another banking situation isn't looming down the road. I'm certain that there are a couple of banks here and there that could be, in some significant stress. But I think the formula and the pattern and what's to be expected has already been set forth. And I think we're going to see, if we do see something like that, will be forced marriages over some weekends with larger banks taking over some smaller banks that could be in trouble. And what happened? And ultimately, as I said, the Federal Reserve discount window and borrowing. This chart essentially just shows in times of crisis, the Federal Reserve is the lender of last resort. And so the banks go to the discount window to access additional liquidity when there is stress. And this just shows that on the far in 2023, that there was stress in the banking system, but the Federal Reserve and the discount window was open, and that provides liquidity, which also stems off further sort of financial crisis or in maybe even potential recession. Now, speaking of recession, let's talk about recession watch. One of the greats, Milton Friedman. If you don't know who he is, he's one of the greatest economists of all time. And he basically is talking about what's the cause of inflation. Well, it's the cause of inflation is caused by too much money chasing too few goods and services. We saw that in post-COVID, right? The supply chain, we had issues. The world was shut down. We had about $5 trillion of additional stimulus, government stimulus to both the U.S. consumer and businesses. So that money got injected into the U.S. monetary system. And everyone, whether you were staying at home for a couple of years and buying stuff online, well, everyone was doing that. And you had additional dollars because we weren't moving around spending the money elsewhere. And now it's transitioning to a service economy. Everyone's going to restaurants now. Everyone's traveling again. And so that's why we're seeing sort of, if you looked at an airline, airline tickets lately, they're absolutely I don't even think inflation's the word for them. It's just obscene. Simply because everyone's trying to, again, now go to experiences. It's an experience economy. Everyone's been shut down and locked down for a couple of years now, and they've got some discretionary income. So now they want to see the world. Well, it's time to do that. So that's essentially what Milton Friedman was talking about. And we're living that real time. And that's a big problem for the Federal Reserve. And that's why they've raised rates significantly. And inflation is a monetary phenomenon that's created or stopped by the Federal Central Bank, which is the Federal Reserve. And inflation is also critical because it's also taxation without legislation. Because your kitchen table economics, if you've been to the grocery store lately, you realize that there's shrinkflation, whether that's the ice cream or cereal, they are basically charging the same or increasing the prices. and they're reducing the ounces in. And that's called shrink inflation. And that's additional tax for you and I. Everything costs more and more. And that's why we have to invest. We have to invest for and look towards the long term, because that will be real assets like stocks or companies that grow over time. Real sort of metals, they gold and silver and everything grows over time in terms of stays ahead of inflation. And real estate as well. Those are assets that grow and hedge for inflation, and that's why it's so critical while the Federal Reserve ultimately tries to get a handle on this. But one of the best quotes is right in the middle. And this is from Milton Friedman again, and you can't disagree. He basically says, if you put the federal government in charge of the Sahara Desert in 5 years, there'd be a shortage of sand. And essentially that's what we're going to see. Debt ceiling debate is upon us. Now, inflation is off its peak, but the trend still continues. And essentially this is a recap from the Bloomberg terminal that shows the history of inflation going back to 1972. And as you see the peaks and valleys, inflation has been well in hand for quite some time in the mid 90s. But if you go back and look at the 70s, that's where we had, again, a lot of different, so actually 3 different Federal Reserve chairmen until Paul Volcker came in and broke the back of inflation. And that was critical. And that was so important that it actually set up a 2-decade expansion from the 80s and the 90s. And we did see some substantial growth in the equity markets and real estate markets. So that's why it's important to get a handle of inflation. If you go all the way to where we are in 2023 right now, you can see off of the peak, well over the 8% mark. We're coming down. Inflation is trending lower, but there's still more work that needs to be done in terms of the equilibrium here. The Fed's target is 2%, so we're well off of that, but maybe 3 points above that right now. And so the Federal Reserve will keep raising rates until the Fed funds short-term interest rate is higher than the current inflation rate. And that's one of the keys and the tricks to getting inflation down. This is a technical, we got, as I said before, and I referenced a lot of individual independent research firms. Strategis is something that we read on the daily. They're, constant 1 or 2 in terms of one of the best sources in Wall Street. They get voted that by their peers, and they also get, accolades for having it right. So we're always looking at Strategis, and they do a fantastic job. This is basically a look at and a snapshot of the VIX on the bond market, the volatility market of the bond market. And if you've had time with Blanke Schein Wealth Management in the past, and you've spent time with Rick or myself, we spent a lot of time talking about the bond market, because the equity market is a sideshow. The bond market is 10 times the size of the equity market. And the reason why that's important is because it usually is a leading indicator as to what's to happen in the economy. It's a leading indicator. Sometimes it fights, the bond market fights with the Federal Reserve and disagrees. And it's also a leading indicator in terms of stress or credit risk in the economy, therefore what's going to happen with the stock market. So we spent a lot of time, and what we saw this most recent quarter is the regional bank run. And you can see going through, there was a temper tantrum. You've had Lehman Brothers, and the Enron bankruptcy in 2000 and to 2002, 1998 long-term capital management. Is exactly what happened, much like in the bank run. So what happened is long-term capital management was basically a hedge fund that blew up. And the federal regulators said to Wall Street, it's your job. You take the risk. It's your job to clean up the mess. So they passed around a hat, and ultimately everyone had to put in the kitty to ultimately bail out long-term capital management. And then ultimately the market was up in 1998 and 99 as well. And so who knows where we are. The bank run, everyone said to the federal regulators, said to a lot of Wall Street, you guys have to sort of clean up the mess as well, because you guys are taking on the risk. And we know that Congress in Washington is leaning that direction as well. So history repeats itself in one way or another, but this is sort of an indication of what the spreads look like and the sort of the concern in the bond market. Now, let's talk about stress and the consumer. This is a consumer stress indicator, another chart from Strategis, and it talks about like as I described before, the food that costs more, plus the mortgages, plus your gas prices. Now, again, it's off of the peak, so that financial stress of the cost of everything has come down. But again, it's still significantly way too high. And it's eating into the consumption. It's eating into sort of the livelihoods and the ability for the consumer to maintain this. And that's one of the key concerns we're going to discuss that could eat into corporate earnings that could then translate into what's to come. for the markets. Again, this is another look at the consumer stress indicator, consumers revolving credit. Now, one of the key measures that we look at in terms of high frequency data, or how is the consumer holding up? Because that is a picture preview. That's the front end, right? Remember, 2/3 of the US economy are US consumers. So where you and I spend our money, and sort of the velocity. Are we slowing down? Are we continuing? Do we have money in the bank, right? The M2 money supply. It's again a Federal Reserve look as to where our savings rate is, and that's been coming down for most of Americans. But that's natural because the additional stimulus money that everyone received was in their bank, and now they're drawing it down to live on, or basically stay ahead of inflation. Now, this chart shows that the current level of revolving credit, which means credit card debt, if you will, or debt for anything that you see, let's say cars or so on and so forth. Obviously, the levels are elevated because the internal interest rates are higher. So the consumption rate is even higher in terms of paying off on a monthly basis. Your monthly revolving credit is higher there. But the long-term average, or excuse me, the average most recently from 2012, our most recent time in stress on the consumer that we can reference to 2019, that level is at a 6.6%. Now we're trending towards that level, but if we don't get closer to that, that just means that the translation is that the consumer has more room to run. And historically, way back when, we've even had it up to 9%, going back to the mid 90s. So the consumer, again, the health of consumers there, but it's stressful because of the inflation. Now let's talk about earnings and the earnings forecast. And this is a US earnings growth estimate, and it's continuing to, be in a choppy trend. We just finished the first quarter for US companies to now are now reporting. We're in reporting season for their first quarter earnings, and we're listening intently on the earnings call. Right, the headline numbers, what they earn and what they take home, and what they basically have done for shareholders, if you will. But how are they navigating through the inflationary inputs that they're dealing with in terms of employment, right? In terms of inflationary pressures with employees and the wage fight right there. And then ultimately, are they growing the bottom line, and how are they doing it? And this is the look into the S&P 500. So let's talk about the blue line first. The blue line is a historical look going back to 2015, projected into 2023. That blue line is the S&P index earnings per share forecast in the next 12 months. So ultimately, it's where the earnings are projected to be by what companies report, and where analysts ultimately all put together their best guesses. Now you can see the green line is the actual performance of the S&P 500. Just a quick reminder, earnings move markets, and that's why the S&P 500 is so predicated on their earnings reports. Are companies making money? If they're making money, stock prices are going up. If they're losing money, or they're having inflationary pressures or cost issues, or basically a one-off sector issue, then the stock market or that equity sector is going to fall back. And it's a constant sort of, sometimes equity valuation or the stock market is overvalued relative to where earnings are. And sometimes, as if today, the S&P 500 index, or where it's trading today at its current level, is below where current earnings are. Now, Rob, why would that be? Why shouldn't the S&P be where earnings are? Well, it's always a guess, number one, right? So it's never an accurate 100% on the mark, as you can see by most recent history. But also, the S&P, or excuse me, the markets in general are a forward-looking discounting mechanism of what they can see into the future, or what they're projecting or even predicting into the future. And again, it's not an exact science here. So that's why there's that disconnect, if you will. But what it is telling us right now, that earnings expectations are in the $220 for the S&P. Some analysts are putting the expectations down to $200 per share. And some analysts are putting it up to $240 per share. So no one really knows that the market's trading around $220 right now. And so that ultimately shows, if we stay where we are, that the earnings forecast for the S&P 500 is a 1% growth rate, which means they're contracting. Usually earnings grow by anywhere from 8 to 10% consistently, unless there's a recession ahead or some troubled times in the economy that the basically S&P 500 has to deal with. And the constituents, if you will, on the right-hand side that you're seeing, is broken out by consumer discretionary and all the 11 sectors on the S&P 500. Now let's talk about consumer discretionary. It's exactly what I just reported. You're going from goods to services, right? It's now everyone has money. They want to travel. They want to go into an experience economy. So the discretionary spend, there is an earnings per share growth estimate of 26%. So there's growth of double-digit rates in all the categories from the consumer discretionary, consumer services, even financials, believe it or not, are expected to grow. That could come down, I suspect, a little bit by the time this has been reported. But this is the third quarter, or excuse me, the first quarter, 3/31 of 2023. So energy is shrinking, but that's simply because year over year earnings on energy has grown so much significantly. We still believe, and we still like energy, and we still believe that even though the earnings year over year are down or projected to be contracting, the growth is still built in because of some structural sort of tailwinds that we'll talk about a little bit later. So the Federal Reserve, with a history of raising rates, if you will, it's essentially recessions typically follow tightening campaigns. Whether the Federal Reserve raises interest rates in May or not, that's still to be determined. And in fact, they're data dependent. Right now, there's a 72% chance by future Fed funds futures pricing in another 25 basis point rise in interest rates. And by all, basically a broad sector of a lot of the economists believe that we should still be in the 5 to 5.5%, maybe even 6% range to again get our Fed funds rate, our short-term nominal rate, above where our inflation rate is, because then it can start driving down inflation. And ultimately, that's what the Federal Reserve has aimed to do. And here's what's interesting, going back to the 1970s. Again, this is another strategist chart. This is the blue line is an indication of the Fed funds target rate and where it actually was. Now, the purple, or excuse me, the gray lines that you see subsequently follow some of the highest rate hikes that we saw, or the end of the tightening cycle for the Federal Reserve, were recessions. So if you followed along at home, and I know most of you have, and I appreciate that, one of the key things that I keep bringing up, whether I'm on TV or in front of our clients on our review, is that the Federal Reserve is going to raise rates until something breaks. Historically, that's what this chart actually proves. It yields out. So a lot of economists are saying, hey, wait a minute, they could raise one more time, but they're going to have to, if the economy starts contracting, or there's a special event that happens that no one can foresee or even plan for, they're immediately going to have to go start lowering rates. And actually, if you look at the Fed funds futures for 2024 for next year, that is indicating just that rates will start coming down once we get to sort of this peak. Let's say the Federal Reserve is going to get to where they're comfortable, and they're going to hold it for as long as they can. And then ultimately, they're going to start lowering interest rates when something in the economy is not working out. Now, this is a great historical, basically snapshot of bears versus bull markets. We've been in a bear market, and that's defined by the markets going down by 20% from peak to trough. And we had that last year. And so if you can see this indication here, what this chart shows is essentially history suggests that investors can improve their returns by embracing risk at a time when others are selling. And we also saw the markets bottom back in last October. We don't know if we're going to retest those lows, but what this does is show the S&P 500 and the last, basically indicating all of the declines by 20% or more over the last 11 times in last since 1950, if you will. So if you look at the blue line, that's the performance of the S&P 500 on the downside. And the little circles are indicating basically 20% or greater decline through that historical year as represented. And what's great about this is using history as a guide. The bear market, every bear market ultimately has a big payoff. And we don't know what 2023 will hold or 2024 will hold, but we do know that we did enter a 20% decline in the S&P. back in 2022. And that's the last line that has all the question marks, but let's look at the lines above, or ultimately the bear markets above that include historically going back to 1956, 61, 66, 68, all the way in the 70s, 80s and 90s and 2000s, when peak to trough, when the market was down. Let's take the first one as an example. So you're looking August 3rd, 1956, the market was down by 20%. And the 1 year performance later after that was 36% on the S&P 500. And then the 3 years annualized, which means you get that you receive that every single year, a 13% per year annualized return. So that wasn't bad. In fact, if you go down this chart and show the bear markets happen, they're going to happen. They're part of the natural course of investing. And that's something not to be, that's something to be prepared for and positioned for, so we can limit the downside, but also stay in the game, because that's when the biggest returns come from the equity markets. And it shows year one, going all the way back for the previous 11 times when the S&P 500 was down by 20%, pretty good historical returns by riding it out. Now, where are the opportunities? We say as you know, we overweight quality, value, and defense. And we emphasize targeting sectors. Again, who would have thought that the big bounce back, the best performing sector this year was, for the first quarter at least, information technology. One of the reasons why is technology, large cap specifically, does better when Federal Reserve's basically at the tail end of a rising interest rate cycle. And so that's where we are. We're in the 2023, who knows, but we do know that the Federal Reserve is closer to the end of raising interest rates on their cycle, whether they hold it or not. That bodes well for information technology or large cap growth stocks. And that's why they've actually outperformed. Again, I said that the S&P 500 index is the future discounting model of sort of earnings and future earnings. So that's why I said, wait a minute, it was down way too much and it discounted way too much, especially if the Federal Reserve might be on pause later this year. Healthcare is a good defensive play. Again, financials provide some, again, even deeper value right now. And there's also utilities. Utilities provide income, 5-6%, while we wait and we clip those dividends and either reinvest it or live off of them. But we are always looking at the value, and we're doing our screening based upon valuations, price to book, price to earnings. And we're trying to minimize the exposure to basically non-profitable or expensive sectors or even companies. That's why we believe in quality and cash flow. One of the sectors that we believe should continue to do well, again, from a structural setup, OPEC and cuts, the Strategic Petroleum Reserve levels are historical lows. And we believe that as the U.S., whether we have not a pro-energy stance, the rest of the world is going to still use energy. And that's really cutting off supply. And as you cut off supply, then you have, again, a demand problem, because you're going to have a lot more people. Obviously we have the Ukraine-Russia war, which now is diverting oil from Russia, but China picked it up. And so, it basically, while we feel better about ourselves in the short term by cutting out, and other sort of countries feel better about icing Russia out for their wrongdoing and what they're doing right now. Unfortunately, China is coming out of, unfortunately, somebody else is going to pick up the slack and then some. And if you look at it, China's coming out of COVID. Now they're rebounding and their economy is growing because everyone's moving again, and they need the additional energy as their economy starts to continue growth mode, post their COVID lockdowns, if you will. So again, that's why we believe structurally there's going to be a bigger setup here. And this is just showing positive for energy. This is showing the U.S., our current inventories and our strategic petroleum reserves are at critical levels. I mean, so if we're going to start building that back up at some point in time, could be this administration, could be next administration, who knows? The reality is that we're going to have to build up our strategic petroleum reserves, and it's a matter of national defense. So when that comes back online, in terms of we become a net buyer, that's going to be additional demand. That's going to be not in the it's not in the marketplace right now. And ultimately, the Federal Reserve is not going to be welcoming that information, because that's going to spike energy prices, which is the inflationary issue that could hit consumers all over again. And don't forget, we're about 1.5 years away from another election cycle. And so you can't have high inflation moving into an election cycle Well, you could, but historically that doesn't play out for the incumbent very well. Again, energy staples, healthcare, materials, we like to overweight. And those are sort of our sector overweights for the second quarter. And then what to watch. Now, a lot of clients have asked, and a lot of real estate transactions we've helped them with, or even guidance in their financial plan as to what the best way to structure, let's say, a bridge loan on their portfolios to basically buy a house and secure a house before they sell their existing house because the housing market has slowed. We've been able to help and do that several times this year, even last year, and we continue to do that. We're happy to have that conversation. But at the same time, this is also to be noted that there is a shortage. If you look at the last 3 years, going back to the last great financial crisis, the home builders basically shut off supply. And if you look at, we have the younger generations now onboarding. You saw COVID say, hey, listen, you could work from anywhere. Technology, you could work from your kitchen table in Palm Desert, California, and you don't have to deal with the traffic in downtown LA anymore. So we're seeing a net increase depending upon where you're seeing. Some states like Tennessee and Texas and a few others, clients are moving and younger generations are now nesting. And so there's that demand, and there's still a shortfall of 1.6 million homes each year that are in need because of the demand. So whether housing got ahead of itself from a pricing standpoint, the supply and demand will equalize. And I don't think we're going to see it down 20% in the housing market. And again, housing is always local and it's always relative to that particular situation. Some people need to sell. Some people don't need to sell. And there's a lot of mortgages that are 3%, 30-year fixed or even better, believe it or not. And they don't need to sell because why would you trade up to a 6%? Again, those shadow inventory of those people are not going to move. Again, adding to why you may consider, if you're thinking about buying a house, this is a buyer's market. You can set your terms because a year ago, 2 years ago, it was a seller's market, and that has flipped. It's very healthy right now, but I wouldn't hold my breath. I think a lot of people are waiting for real estate to drop by 20, 30, 40, 50%. And we believe because of all the structural reasons, that's just not going to play out. So if you're in the housing market, great. Poke around and see what if you can pick up a deal, because by the time you feel the headlines and the national news comes up and says, okay, now it's time to buy a house again, you're not going to get that deal. The advantage goes back to the seller, not to the buyer. So this is a buyer's market. Take advantage of it if you're looking. We talked about gold. Gold prices and are hanging in there. Kind of a historical fact. The last 30 years, gold has actually done as well as the S&P 500. With a 440% rate of return, or 8.2% per year. So both of those have hung in there. It's just one does better than the other depending upon cycles of the economy. Right now, gold seems to be on an uptrend. We like gold. We're adding gold to client portfolios, as well as Dr. Copper is resilient. It's in everything. And it also indicates whether the global economy is growing or contracting. And that's one of the reasons why we keep copper on our dashboard here at Blanke Schein Wealth Management. We're just showing you that copper prices are hanging in there. And so all of the metals and miners we do like structurally because of that. We also like crude oil I talked about. And the labor market tightening, we can see some signs in the labor market move into the direction of the Federal Reserve wants them to move. They literally say that we need people unemployed for the Federal Reserve to stop raising interest rates, which is kind of crazy because he worked so hard to put together a healthy economy, a gainful economy for every cross section of the economy and labor market and people who need and want a job. But now they're hell bent on wrecking the economy so that there's less tension in the labor market, bringing down inflation, which is just crazy to even think about. Cycles of the markets. Again, this is just, again, the market going back to 1926. Markets climbed the wall of worry. And essentially the bear markets are short and the bull markets are long. And that's basically the take home point. You have to sort of go through both of them to get the long-term investor benefit. And this is that, again, long-term perspective of market downturns and historical bear markets. We're in a bear market. We don't know when this will end. We don't know if it's going to be a mild recession, but ultimately you hold on. And this chart here, you can't really read it. I can't read it. I don't even have my glasses on. I can provide it for you if you want it. But again, it just shows you go through sort of the downturns And we protect that by having a balanced, diversified approach. And that helps us. We win by not losing on the downside. It's basically your downside capture ratio is limited, and then you capture the upside when it's time to play offense versus defense. And this is kind of a cool chart. This shows the S&P 500 rate of return by their calendar year. And ultimately, everyone knows that the S&P has an average of 8 to 10% rate of return, long-term historical average, which is that blue column. But it just doesn't give you an 8 to 10% year-end return. It gives you maybe a more than 20% return. And that big green sort of column right there shows you all of the years the S&P 500 has had a greater than 20% rate of return. So we can't say, hey, listen, if later this year the S&P 500 sniffs out that the Federal Reserve is done and that it's a mild recession and the earnings are discounted way too much, that we can't see the market continue its positive uptrend. But ultimately, you have to have investments in the equity market to take advantage of this. But this is clear. Markets do, again, have outside returns, even 12 to 20%, which is that second column right next to it. And the other two columns are all positive, sort of by their calendar year and what they've been able to yield. Now, all the way on the other side, you have, markets are down. And what you can see here clearly is markets that end down 20% or greater, historically speaking, and we've seen a few of those in the last few decades, are not as great as those that are on the upside surprise. And so that's why, again, long-term perspective and own quality and know what you own and why you own it. And markets long-term reward those that are patient. And the green dot just shows along, historically speaking, the calendar annual return. Every column is a calendar return based upon large cap, mid cap, small cap, cash, real estate, and different sectors and diversification, asset class performance. But the black is blending all of them together. And so it's a diversified portfolio. It's basically why we construct a diversified portfolio of Blanke Schein Wealth Management for our clients, which is stocks, bonds, cash, alternatives, which include metals and inflation hedges, if you will. And that basically gives you sort of the middle. You're not going to be, leading the charts on the upside. In some sectors and some investments within your portfolio, yeah, we'll take advantage of it. But we're not going to go 100% one sector. We're not going to go 100% sort of one style, if you will, because it's too much volatility, because it wins and then it goes all the way to the bottom. Our job is to make certain that we're having we limit the volatility so that you are in the game and you get the most and maximize benefit. And over time, you'd be surprised that a diversified portfolio, slow and steady, wins the race. It keeps the clients engaged. It keeps your statements sort of less volatile, and it keeps you to the plan. And ultimately is keeping everyone to the financial plan and meeting and exceeding your financial goals. And this is another chart, best, worst, average investment returns for asset allocation since 1976, if you will. Easy way to look at this is if you're all in bonds, if you will, the first line up top. The worst year, if you're all in bonds, is down 13%. Actually, we saw some bond markets down 17% last year. But the best that the bonds have done in one calendar year historically back then is 32%. And then going all the way down the spectrum, if you're 100% equity, well, you could expect, if you're invested 100% in stocks, you could expect, a 37 to 40% downside. That is possible. But you also are, banking on that you're going to be in it for the 37% on the upside. That's why we land in the middle, the 60, 40, 40, 60 blended portfolios. Again, it gives you sort of downside protection without stretching too much, but also a pretty good upside capture ratio of what markets have to give. It's just another look at it. I'm not going to belabor the point, but let's talk about a recap and next steps. And I appreciate everyone being with us for 43 minutes. And again, if you want to pause or go back or talk about other topics, we're happy to do so. Blanke Schein Wealth Management. But let's just recap real quick. We still believe that there's going to be outside volatility, and rates are likely to stay where they are, and the uncertainty is going to persist. So we will then take advantage of strategic rebalancing. One of the things that we've been really seeing an influx of, and that's one of my points here, is we've been putting small and regional bank cash to work. We saw in the first quarter a huge net inflow of client assets to us that had, their banks, their money that wasn't earning anything at the bank, And we saw significant inflows, and we put that in treasuries, and treasuries are yielding over 4%, depending upon the duration that we go out. Some of them are closer to 5%. And so, yeah, we like the full faith credit of the U.S. government, and give us a 4.5% interest rate versus the bank across the street. You don't have to worry about it, and you just put it to work and have your money working for you. So we've seen an uptick in that. We will continue to see that. But the outside volatility is then we put the strategic rebalancing across and take advantage of that in a proactive approach. Again, we have discretionary authority to be proactive, as we did with our client portfolios in 2020, in March of 2020 and April 2020, when the market was down significantly. We rebalanced to more equities, because we saw that, listen, we believe that we didn't know what COVID was going to do, but we did know that the cash flows on some of these companies, a lot of the technology companies, were not going to be impacted by 40% decline in the stock market. Their cash flows weren't going down by 40%. So we're like, listen, let's buy in. And we were able to strategically, proactively take advantage of that. And we saw significant upside capture on that. And clients love that. Again, we're hanging out, we're being patient, because the volatility is going to persist, and we will do strategic rebalancing. If markets give us that opportunity, we're putting your bank cash to work at 4%, and we're getting, you're getting paid while you wait, and be patient. And then we take advantage of downside markets. So if you have additional assets outside, they're not doing anything for you, please give us a call or talk to us. We're happy to have that conversation. We do, in the next 12 to 18 months, we're bullish. We're slightly bullish on the equity markets. Again, we still think that the markets could pull back. We don't know if we could see the equity markets retest October. That probably is an outside sort of, maybe it's the debt crisis, sort of the, Congress agrees to disagree, and they use it as a political sort of leverage point to get their point across, to see sort of, set up for 2024. So that could add more stress in terms of volatility in the market, but the underlying companies will take advantage of scaling in and buying into companies, even if they're discounted by the headlines. We love those opportunities, because that increases future returns, as well as we're doing client reviews. One of the key topics that keeps coming up is clients are asking, do we have minimums? And, off the street, somebody we don't know, yes, we do. But for next generation, whether it's kids, grandkids, great grandkids, this last quarter, we saw a significant increase in terms of just having that conversation. Listen, if you want to get your great grandchild involved in Blanke Schein Wealth Management, we don't have a minimum. We're happy to open up an investment account. We're happy to give shares. We're happy to start the conversation. We have got a lot of sort of families brought in teenagers and having a conversation about, trust me, I'm in a household of teenagers, so I know what it's like, and I'm happy to connect with those and have conversations with sort of the next generation and get them interested. If the markets are down and we seed them with some education and we seed them with some opportunity, and give them a little bit more money right now to invest, or start them off right now, long term, that's a home run, right? It's a win-win. They're looking out for their financial future. They're getting connected with Blanke Schein Wealth Management. Have them get connected with all of our social media handles. We believe in financial literacy, education, and we're happy to do that. So again, the next generation, we're happy to work with, start the conversation about investing, saving. We're just being proactive for your financial future. So again, we don't have minimums for friends and family. So we want to get that message out. I believe that's all we have for today. Again, we're cautiously optimistic for our sort of the next 6 months. We're here for a review. We thank you for your time, your dedication, your confidence in us, and we're working tirelessly around the clock, because money never sleeps, and we're happy to be here for you. And from all of us, from Rick Jr. to our whole team, Sherry and Leslie and Corbin and Jason and Val and Mike and Rick and Don and everyone in Wisconsin, we appreciate your time today. And if you have anything for us, please reach out. We're happy to have that conversation. You guys have a wonderful day, and we'll talk again soon. Thank you. Bye-bye.